At New Builds Calgary, it is our mission to strategically align discerning buyers with preferred builder and location, and streamlining the home acquisition process with unrivaled efficiency. So today we are joined with my friend Ahmed Hatata with Green Mortgage Solutions, who's going to walk us through the process of mortgaging a new build, whether you're a builder, an end user, or an investor. So Ahmed, thank you for joining us. All right, so Ahmed, what do you think is your client's number one obstacle when it comes to financing a new build?
So I guess that's a broad question, but in a short answer, it depends if you're dealing with a builder or an end user. Some things that are unknown, with new construction, there's so many steps along the way. So are we buying just land, or are we buying land with a house on it that we will have time to get prepared with the site plan, the development permits, building permits? So I guess there are many hurdles that we have to go through, and each person is different. So I hope we will be able to cover at least a few of those areas to clarify it more for everyone.
What types of loans do you offer when it comes to financing new construction for your clients?
So the most common type of loan for new construction would be a progress draw loan. So what that means is that you're either buying or refinancing a piece of land, and then a construction mortgage is typically something that will fund the construction through different stages of construction, as early as just land, and we can fund a portion of the land, and then you will have to put in your equity, which we will talk about that a little bit more. And then as you progress through construction and reach different milestones, we can get something called a progress report to verify percentage, or through a QS draw process, all the way to 100% completion. And that's generally the short version of how to fund or how construction mortgage works for most people.
Okay, very interesting. Thank you. So we hear words like loan to value and loan to cost and so on and so forth throughout the industry. But can you please elaborate on that a little bit? Tell us a little bit more detail about what that means exactly.
Yes, of course. This is a very common question, and it can be easily mixed up. So it's very important to understand the difference. It's very simple, actually. So loan to value is a loan that will be given to you based on the value of the house or the value of the completed project. So you're building duplex, it's worth $750 each side. We're going to give you 75% of the completed value. Now, loan to cost, that is something more for builders. So based on your budget to build now, not the cost, not the completed value, sorry. So based on your budget to build, that is the amount of loan you will get. So 75% loan to cost is simply 75% in the form of a loan amount of your budget.
Very interesting. You learn something new every day. So what can you tell us about private financing?
Yeah, so private financing is mostly common for builders. So with private lending, obviously it's less paperwork intensive. It's more based on the equity, and it's for people that might have less money or sometimes not as good credit. But at the same time, you might have the best credit and a very long history as a builder, and you just want a simplified process to get money for construction. So you go the private lending route. Now, you will pay more in interest rate. These days, today, you're looking at prime +3 minimum for a construction mortgage with a private lender. And since the rates have gone up, the bridge between A and private has really gone down. But what I find is most of my clients, we go through the private lending route when we are funding construction draw mortgages.
So on the other side of that coin, what can you tell us about A lending?
Right. So A lending, unlike private, you'll get technically better interest rates. I mean, these days interest rates are high, so it doesn't matter where you go, it's still high. So prime +1 to prime +2.5. Now we're talking a better interest rate because you're with an A lender. That comes at a cost. You have to have the experience, You have to have the equity into your project before your draws will start. So all your equity goes in first, and you will be vetted by the A lender with financially and personally and experience-wise. So it's a lot more intensive due diligence process for sure. And the draws are a little bit different than private, and a less, I like to call it a less personable experience sometimes, because with private, sometimes we deal with one person and that's it. With a lending, it's an entire institution or lending institution that goes all the way to Toronto and back here. So some differences for sure. There's a lot more to it, but that's kind of the basic short answer.
Okay.
Yeah.
Excellent. Is there any other sort of outside the box ways of financing that you could tell us about when it comes to financing new construction?
So that's a great question. So a lot of the struggles, I would say, that people have is, how do we transition buying the land into starting the construction? Because buying land is a very hard thing to finance when it's just bare land. You'll have to put a lot of down payment down, and most people don't want to put 35 to 50% down. So we usually have a couple of steps for and solutions where we'll say, hey, let's finance the land or the land with the house on it in a completely different route to save you some equity in the beginning. So you can spend your money into putting plans like the site plan, your development permit, your budget, your interior design. So once all that's ready and we get an appraisal, then we're ready to execute on the construction mortgage. And explaining that process makes people a lot more comfortable knowing that they can close on the land, they're good, let's get to work, and we'll come back to financing when we're ready for the construction.
Interesting. So it's almost like a two-stage process?
For most people, it has to be a two-stage process. You can't really get into construction financing unless you know what you're building. And you're not going to know what you're building until you have your development permit at least submitted or approved, depending what you're trying to build and how much resistance you'll get with the city, we like to say. So, but we can start as early as development permit draft drawings. If we know that is something that has been proven, you can probably build this and it will be approved by the city, most important.
Wow, interesting. And as many people are talking about right now, I think the three most common letters in the alphabet amongst builders are MLI Select. Yes. So what can you tell us about MLI Select that is so interesting and so unique, and how it could benefit builders, investors, and potentially end users?
So the CMHC multifamily program has been around for a long time. I've been practicing financing this program for over 10 years. It's only gotten lots of attention recently because of the MLI Select program. So the things that we saw change is the regular stream used to give us things like 85% loan to value, pretty high premiums at the maximum loan to value, which is over 5% today, and amortization as high as 40 years. MLI Select, why it's so awesome, is because now you have an amortization of 50 years. You're paying a maximum premium for CMHC insurance premium of 2.55%. And you're getting as high as 95% loan to value. Whoa. So that is why CMHC MLI Select is awesome for rentals, and there are criteria like affordability that is the most popular stream, we will say.
Okay, that's very interesting. And so if a client came to you and said, hey, Ahmed, I want to grow my portfolio, how can you help me strategically align myself so I can get ready to build out, 5, 10, 15 projects a year? Like, how would you help them set up their infrastructure to ensure that they can make sure they can scale and build at a rapid pace, but still be able to have that level of security as well?
So a lot of my clients used to build cash only. Now, what is the return on building cash? It's not going to be that great. Yes, it makes you feel secure, nice and comfy and cozy, but are you really making an impact at the end of the day building one house by using 100% of your cash? No. So how we would like to strategically help a client maximize profit and ROI at the end of the day is, look, instead of putting $1 million in one build, why didn't you put $1 million in 4 builds? So we will satisfy the average is 25% equity of each project. So if a project costs $1 million, you'll put $250. Let us leverage the other $750 in financing. The other $750, don't worry about payments. That is all in your budget. So you're not going to make any payments through the lifetime of the project. Does that sound good to you? Most builders would agree. So now, and it has been proven in the past with many of my clients that are rich enough that they don't even use me anymore. They were able.
That's too bad.
Yeah, it's okay. We stayed friends.
Yeah.
They were able to do multiple projects throughout multiple years to achieve that level of financial freedom, that they are still able to do multiple projects, but not necessarily need financing anymore, which is okay. So,
Wow.
that is the end goal that we want.
I love it. Take the banks out of the equation.
Yeah, well, may introduce them and take them out.
Yeah. And so what are some tips and tricks, strategies, et cetera, that you've seen really capture builders' attention that you think other builders should pay attention to?
100%. So I've done this myself because I do build. You should know this. You saw my stuff just. So let's use a real life example for a project. So let's say we buy a house that we're going to build a duplex on. This house cost $600,000. We're going to close it with conventional financing. We're going to get a nice A mortgage and rent it out for the next few months until we figure out our stuff. Now the development permit and building permit is ready, we can get appraisals based on the subdivided value of the lot. Guess what that will be. You pay $600. I guarantee you the subdivided value of the lot is going to be at least $350, $375. So what happened here? We just created equity of about $100,000 to $150,000 to help the builder when we transition to a construction mortgage. So if you don't get what's happening here right now is that we're going to a construction mortgage lender with a value of $700 or $750 for something that you paid $600 on, because there is a legitimate value for a subdivided lot that people don't realize. And this is a fantastic trick, and I'm giving away gold here. And this is how we help builders put less equity in a project to get it started and satisfy that minimum equity requirement you need for any construction project.
Wow. Sounds like that could be very beneficial if a builder's trying to leverage and scale as well too, I guess, hey?
Absolutely. And that's part of the kind of the whole process and how we put it together.
So people talk a little bit about the point system with MLI Select. What can you tell us about that?
Yeah, so with MLI Select, you want to qualify for the full 100 points, we say. Let's say there's bronze, silver, and gold package when it comes to CMHC MLI Select. Most of the time, we want to go for that gold package. You're not really giving up that much. Because you need to give CMHC either 15 or 25% of your gross floor area, which translates to, 2 or 3 out of the 8 units of a fourplex we were talking about earlier, and basement suites only. As long as you give them that promise, you will rent those at the affordability rates for the next 10 to 20 years. That's how you qualify for the full 100 points. Because otherwise, you won't get 50-year amortization, for example. If you're one step below that, you'll go back to 45-year amortization. So that you start losing certain things. So for the CMHC MLI Select program affordability route, the best thing to do is to qualify for the 100-point. And it's pretty easy to do that with most structures.
How do you define the loan amount with CMHC, or how do you get to that point?
Right. So CMHC uses a valuation process called income approach. It's different than market value. So income approach is going to be solely dependent on what the revenue that you're collecting for rents and what are the expenses that are attached to that building or apartment building specifically. So based on that calculation, we reach a net income amount. So based on that net income amount, we will know how much money you will get from CMHC. And based on that, hopefully your budget to build makes sense versus that loan amount. Because at the end of the day, you can build it for 2.2 and I can probably get you a loan for 2.5, but CMHC will always give you the lower up. So they'll give you 95% of your budget. They won't give you 95% of the value since you're building them.